If you just divorced or you are finalizing one, failing to update your estate plan could cost your heirs hundreds of thousands. Or worse, leave your ex with assets you thought they would never get. In the next few minutes, I'll show you the 3 critical updates families often miss after divorce and exactly how to get them done. Let's get straight to it. Beneficiaries override everything. They beat your will, they beat your trust. Think of beneficiaries like the shipping label on a box. If the label still says your ex, the money ships to your ex, period. Let me give you a specific example. You have 3 IRAs, one at Fidelity with $400,000, one at Vanguard with $250,000, and one old rollover IRA at Schwab with $150,000 that you opened years ago and basically forgot about it. After the divorce, you worked hard to protect your kids. You updated your trust, you removed your ex, you did everything your attorney told you to do. But you only updated the Fidelity beneficiary because you see that account every month. You forgot about Vanguard and Schwab. You pass away. Your kids expect to inherit based on your trust. But that Vanguard account and that Schwab account still list your ex-spouse as the beneficiary. She gets $400,000. Your kids get nothing from those accounts. Your trust can't override it. The beneficiary form is a legal contract. It wins every time. Now add life insurance to this. Life insurance often runs on autopilot. You bought a $1 million term policy at 35 and named your spouse. You divorce at 55. The premium drafts quietly for 20 years. No one touches the beneficiary. You pass at 68. Your ex get $1 million. Your trust still protects everything else. Your house, your investments, but the life insurance never followed those instructions. The policy never cared what your trust said because it still had your ex listed as the beneficiary. So you are looking at potentially $1.4 million going to the wrong person, even though your trust says otherwise. If your plan was to support 2 adult kids and fund a grandchild's college education, that plan just died on paper. And control can be just as costly. If your successor trustee is still your ex, they run your trust when you can't. They decide whether to sell a $1.2 million brokerage account, what to do with a $850,000 vacation home, and when to distribute to your kids. Bad timing on that sale could trigger $60,000 to $90,000 in capital gains taxes, and bad distribution decision could wipe out another $100,000 of long-term value. And while you're alive, don't forget to check your power of attorney and healthcare proxy. If you still list your ex, they can move your money and make medical choices if you are incapacitated. I've seen an old power of attorney move $200,000 under the idea of cleanup. It wasn't malicious, it was just messy. Here's what to do right now. Update every beneficiary on IRAs, 401ks, 403bs, pension, annuities, and life insurance. Primary and contingent. Track down every account, including the ones you forgot about, and remove your ex anywhere they still have control. Trustee, successor trustee, power of attorney, healthcare proxy. And if a trust is the beneficiary, make sure it's the current trust, not the pre-divorce version. Quick note, I'm a fiduciary financial advisor, not an attorney. My goal is to help you coordinate the financial side. Your estate attorney handles the legal documents. Alright, that's who gets the money and who's in charge. But even if you fix all of that, there is a second problem most people miss: titles and funding. Your trust is like a safe. If you don't put the valuables inside, the safe can't protect anything. Same with accounts and property. Here's what I see constantly. On paper, the plan looks great. A $3 million revocable trust with clear instructions. In reality, the $1.2 million brokerage account is still in an old joint title, and several bank accounts never added payable on death or transfer on death designations. If something happens, you are staring at probate, often $15,000 to $50,000. And 12 to 18 months of delay. Then there is the transfer on death remarriage trap. During your first marriage, you set a $600,000 brokerage account as transfer on death directly to your kids. Made sense at the time. Simple, avoids probate, kids get the money. But years later, you remarry and update your trust to provide for your new spouse during her lifetime. Then your kids after she passes. You are trying to balance taking care of your spouse while protecting your kids' inheritance. Your estate attorney sets this up perfectly in the trust. You pass away. That $600,000 goes straight to your kids, bypassing the trust you meant to fund your spouse's income. Your new spouse gets the house, but loses the primary liquid asset she was supposed to have for her lifetime. Now there's family conflict. Your spouse feels betrayed. She thought you planned for her. Your kids feel caught in the middle. They didn't ask for this. All because the TOD designation didn't match your trust. So here's what you need to do. Fix the containers. For brokerage accounts, Either retitle your revocable trust or use TOD that mirrors your plan. For bank accounts and CDs, add payable on death that matches the trust. Or drop the POD and TOD designations entirely and keep them titled to the trust if that better supports your income plan. Confirm changes on statements. Don't stop at submitting forms. Financial accounts are one thing, but real estate and business interests, that's where titles and agreements can create even more expensive problems. Let's say you keep the Colorado vacation home worth $850,000 in the divorce. You refinance to remove your ex. You update the trust to leave it to your kids. Perfect. But no one retitles the deed. It still shows joint tenancy with right of survivorship from years ago. You pass. Your trust says kids. The deed says something else. Now your kids are fighting over an $850,000 asset and paying tens of thousands in legal fees to unwind a paperwork miss. Real estate titles are tricky because they involve legal documents filed with the county. You can't just call up the county recorder and change a form. You need a new deed, properly executed, notarized and recorded. And it's not just vacation home, it's your primary residence, rental properties, land, commercial real estate. Anything with a deed needs to be reviewed after a divorce. Now business interests. An LLC membership interest worth $700,000 was never assigned to match the plan. Or the operating agreement from years ago still gives your spouse certain rights. Maybe a right of first refusal to buy your shares, or the right to become a partner. You get divorced. You update your trust to leave business interests to your kids. But the operating agreement, nobody touches it. You pass away. Your trust says your kids inherit, but the operating agreement says your ex-spouse has the right to purchase your shares or become a partner. Now your ex can force a buyout, and your kids might not have $700,000 sitting around. Or worse, she could become a partner in the business, creating a nightmare working relationship between your kids and your ex. Let me draw the lane lines. Your estate attorney handles legal documents and recordings. Deeds, compliance, execution, filing. My role is to coordinate what needs changing, how it fits your estate and tax plan, and make sure titles, beneficiaries, and accounts all point to the same destination. You need both working together so nothing slips. Pull every deed, check every title, review business agreements. If the paper doesn't match the plan, get the legal work done and confirm it's reflected in your financial records. Another piece most people completely overlook is tax coordination. And this is where careful planning puts real dollars back in your family's pocket. Let's say you're 66, newly single with about $1.5 million in IRAs. You spend roughly $60,000 a year from investments and give another $20,000 to charity. Before the divorce, you file jointly. Now you are filing a single, which means you'll hit higher brackets sooner. What used to fit in the 22nd bracket might now fall into the 32% bracket. That not only raises your tax bill, it can push your Medicare premiums higher by triggering income-related monthly adjustment amount surcharges. Here's where strategy matters. Once you turn 73, you'll face required minimum distributions. Let's say about $40,000 a year from your IRA. But once you pass 70 and a half, you can use a qualified charitable distribution to send money directly from your IRA to charity. That amount never hits your taxable income. So instead of withdrawing the full $40,000, paying tax, and then donating $15,000 in cash, send that $15,000 directly from your IRA as a QCD. Then, for your living expenses, draw from your taxable accounts, cash, dividends, or brokerage assets before dipping into the IRA. This simple sequence can keep you in a lower tax bracket. Avoid unnecessary IRMA surcharges, saving about $1,500 to $3,000 a year, and maintain your charitable giving while meeting your income needs. The order you pull your dollars from matters. And that's where thoughtful planning makes all the difference. Now, that's one side of the equation. How you manage your own taxes and charitable giving. But that's just half the story. There is another side to it. What happens when your kids inherit those IRAs? Under today's rules, non-spouse beneficiaries must empty inherited IRAs within 10 years. If your kids are high earners, those forced withdrawals can easily add $80,000 to $150,000 in extra taxes over the decade on a $1 million inherited IRA. Here's how. Let's say your kids, Sarah and David, inherit that IRA in 2025, each getting $500,000. Sarah earns $300,000 a year. David earns $220,000 a year. If they do nothing and each take the full withdrawal in year 10, the math is ugly. The accounts grow to about $650,000 each, and that extra income pushes both of them into the top federal brackets. Sarah owes roughly $260,000 in combined federal and state taxes. David about $235,000. Nearly $500,000 gone to taxes on a $1 million inheritance. But if they coordinate withdrawals, the story changes completely. They wait the first 3 years, then take about $75,000 per year each over the next 7 years. That keeps Sarah in the 32% bracket and David in the 24% bracket, far below the top rate. Now their total tax bill drops to roughly $280,000 combined instead of $495,000. That's about $215,000 in savings just by spreading withdrawals and keeping taxable income balance year to year. And if you, as the parent, convert part of your IRA to a Roth IRA before you pass, say $300,000 or $400,000 while you are in a lower bracket, your kids would still have to empty it within 10 years. But those Roth withdrawals would be completely tax-free. That's how real coordination turns a painful tax hit into a smart, multi-generational plan. And there is one more area most people overlook: life insurance ownership. With a $1 million policy, the owner controls the beneficiary. I still see ex-spouses listed as owner on all policies. That means they could change the beneficiary tomorrow. If that policy was meant to support your kids while other assets go to your new spouse, the plan collapses. Verify the owner and beneficiary on every policy. If appropriate, make your trust the beneficiary so it distributes according to your overall estate plan. Before you wrap up, here's how to make everything flow together. Start with a clean inventory. Every account, policy, and property you own. Fix beneficiaries and control roles. Remove your ex anywhere they still appear, as trustee, power of attorney, or healthcare proxy. Next, align your containers. For brokerage and bank accounts, either retitle them to your trust or set up TOD and POD that mirror your estate plan and confirm the changes on your statements. For real estate and business interests, review every deed and operating agreement and work with your attorney to fix anything that doesn't match. Then run your tax sequence. Map out a 3 to 5 year plan for RMDs and QCDs. Verify life insurance ownership and beneficiaries. Coordinate charitable giving and capital gains planning so you are not paying more than you need to. Get this order right and your estate plan works exactly as intended. Miss the sequence and you could trigger penalties, pay unnecessary taxes, or leave control in the wrong hands. Look, I help people work through this all the time. If you want a second set of eyes on your situation, someone to coordinate with your attorney, audit your accounts, and make sure you are not missing anything, feel free to schedule a meeting. Link is in the description below. We'll figure out what needs to happen and get it handled. And before you go, remember that most trusts fail for a simple reason. They are not funded. In that video, I'll show you the one setup mistake that can make your trust completely useless. See you there.